Hello, I'm Loda Smits for the Finance News Network, and joining me from Australian property data provider RP Data is Senior Research Analyst Cameron Kusher. Cameron, welcome back to FNN.
Thanks for having me.
RP Data has just reported the biggest fall in Australian home prices in more than 5 years. What was the result and what do you attribute it to?
Well, home values fell by 1.9% in May, and if you have a look at what we've seen over the last 24 months or so, it's been quite strong growth in property values, and obviously Sydney and Melbourne have been very strong. But on a quarterly basis, value growth peaked back in August last year, and since that time we've seen the rate of growth slow, but we've also seen consumer sentiment falling, and sales volumes are a little bit lower now than they were late last year. So I think it's just some of that exuberance in the market now slowing, but it will be interesting to see if we continue to see falls or we just see more moderate levels of growth from here.
So after such a long period of gains, are we now seeing the start of a correction for home values?
I don't necessarily think it's going to be a correction. If we look at the last 3 Mays, we've seen values fall in each of those months. So we do tend to find a little bit of seasonality at this time of year, coming off a strong performance in the first quarter of the year.
So Cameron, what would you need to see to put Australian home values in correction territory?
Well, I don't think it goes into correction territory until we start to see maintained falls for 6-12 months. And I still think, obviously, it's 1 month of data that we've seen a fall, coming off 12 months where we've seen values rising. But I still think we're a long way from a correction, but certainly certain capital cities have a greater opportunity for a correction. Melbourne, for example, hasn't really seen a sustained correction period since the mid-90s. The Perth housing market has slowed quite a bit more recently, obviously on the back of weaker iron ore prices. And those markets probably are more exposed to a correction than, say, Sydney, where there's a lot of pent-up growth and not much growth in property values over the last decade. And markets like Brisbane and Adelaide, where we haven't really seen much growth in the last 7 years or so.
So if this isn't a correction, where do you see house prices moving from here?
Over last year, we saw values rise by about 10% across the combined capital cities. Our view's always been that 2014 would be a much more moderate year for growth. So far this year, values are up 1.9%. At the same point last year, values had risen by 1.1%. So it's interesting that growth now is actually greater than last year. But most of that growth came in the second half of last year. And obviously that momentum carried through to the early part of 2014. Our view would be that growth this year is probably going to be more around the 5%, so probably half of what we saw last year.
So looking at the latest results, which capital cities contributed most to the falls and what was behind the underperformance?
Well, the Melbourne market saw a 3.5% fall in values over the month. And again, it's been one of the stronger performing markets. 3.5% is a big fall, obviously, on a monthly basis. And we do know that month-to-month results can be quite volatile. But I think if you have a look at that market, auction clearance rates have been falling over the last 6 or 8 weeks. And the amount of new stock on the market is quite high. Total listings are much higher in Melbourne than they are even in Sydney. So there's a lot more stock available for sale and potentially a few less buyers out there. And that's probably impacting the market. But I don't think that 3.5% fall is necessarily reflective of the kind of falls we're going to see going forward.
And on the flip side, which capital city was the standout performer and how much more momentum could be left in these gains?
Well, Darwin saw values rise by 1%, which is obviously quite strong when you consider that nationally values were down 1.9%. The Darwin housing market has had a lot of momentum really over the past decade, and it's really being driven by infrastructure investment both from the private sector and the public sector, and the strong mining segment in Darwin and the Northern Territory. That's probably going to continue for a little while yet. The big question marks will happen once that investment runs out, probably in 2 to 3 years' time, and if we start to see some of those transient workers that have gone to Darwin to work and live start to pull out and move back to where they came from. But for the moment, I think we'll continue to see some growth in that market.
Finally, Cameron, Australia's key cash rate has just again been kept at a record low of 2.5%. Where do you see rates trending and ending this year?
Well, it's an interesting one. If you asked me a couple of days ago, I probably would have said rates would be on hold for this year, and I still think they probably will be, but obviously the risks of a lower interest rate are rising, housing market potentially cooling, Dwelling approvals were quite weak this month, down 5.6%. The economy is certainly not looking as strong as it was a couple of months ago. Consumer confidence is well down as well. I think that interest rates will remain on hold, but I would say that from what we're seeing at the moment, it would be more likely that they might actually be lower than they would be higher.
Cameron Kusher, thank you for the update from RP Data.
Thanks, Lodi.